Hi, and welcome to the latest monthly market update from Zurich Life. I'm Jacqueline. I'm joined today by our investment solutions analyst, Daniel Finucane. We're here to break down the latest market developments, what they could mean for your portfolio up until Thursday, December 11th. So, good morning, Daniel.
Good morning, Jack.
So let's start with the big picture. Can you share some insights into the key factors that drove performance in November 2025 right up to today and highlight any notable sectors or market trends that would have stood out during the month?
Yeah, it's been another busy month in the markets, and I think a key area of focus this month has really been the U.S. economy. We, of course, had the government shutdown, which ended in the middle of the month, and with that came a slew of economic data that had been postponed during that shutdown, and so we really got a clearer picture of the U.S. economy through things like labor market data and inflation data. And that all had a huge impact as well on rate expectations from the market. And that's what I'm showing here is the probability of a rate cut by the Fed in their December meeting and how that probability shifted during the month of November. And you can see there at the start of the month, the market was pricing in about a 60% likelihood of a cut in December. And that fell right below 30% by the middle of the month. And that was due to stronger than expected labor market data that came in. But we then received, following that, some dovish comments from the New York Fed chair, which then drove up that likelihood again and reached right up to around 90%. And at this time of recording as well, the Fed actually decided yesterday evening that they did cut rates by 25 basis points. So confirming the market's expectations, but that real whiplash there in the market's expectation of rate cuts added a bit to volatility during the month, which I can just show here in when I show the VIX index, which is basically a measure of US stock market volatility. And this is a view for the full year. You can see that spike there in early April due to the imposition of tariffs on Liberation Day. But we saw a bit of a level of volatility in the months following that. But you can see there right at the end of the graph, a bit of flare up there in volatility. And that really characterized the month of November, investors seeing a bit more movement in their portfolios last month.
Yeah, the US has certainly taken the spotlight this year, and the key activities within the US are certainly reflected on this VIX chart here. So, looking at equities as an asset class now, how have equities performed overall, and what stood out from a sectoral and a geographic perspective?
Yeah, so starting with a geographic perspective, I have here just a few of the main developed markets and the returns that we've seen year to date. It is worth noting that these returns are in euro terms, and so you can see there that light blue line, that's the US, which you can see is actually lagging behind a lot of the other developed markets in euro terms, and that's obviously due a lot to the weakening dollar that we've had this year. But it's worth noting that because the US investors might have become accustomed to the US outperforming over the last decade or so, but we see it now lagging behind other developed markets, and that really demonstrates the value of diversifying within your equity book as well across regions. And it's also worth noting in this chart, you can see that top line there, the green one, that's actually Irish equities, which have been showing stellar performance so far this year, particularly in the financial sector. But when we look at the end of the graph here at the month of November, you can see that sort of commensurate dip across all of the regions as they all really reacted to those the market pricing in their expectations for a rate cut. And then we saw a bit of a recovery towards the end of the month as a rate cut looked more likely. But turning to more of a sectoral view, something I'd like to highlight here, right at the left side of this chart, the sector that outperformed globally was the healthcare sector, which is interesting to note because that's usually a sector that we would consider to be more defensive. And there's a couple of key reasons for that. One of them being that we saw heightened M&A activity in the health sector. The the healthcare sector last month. So we saw a lot of key acquisitions from companies like Abbott and like Johnson and Johnson, and the market reacted well to those. We also saw very strong earnings in the sector, particularly from companies like Eli Lilly, which really benefited from strong earnings reports at the start of the month. And Eli Lilly actually became the first $1 trillion pharmaceutical company during the month. And the third reason then would just be a rotation out of growth sectors like the IT sector and into defensive sectors like healthcare. And just to touch more on that sort of rotation out of IT, that was really due to a bit of a wobble in the AI rally last month. And what I'm showing here is the returns on the Magnificent Seven stocks in USD terms since the start of November. You can see there only Google really has shown stellar performance during the month. There was a bit of healthy performance in stocks like Apple and Meta as well showed a bit of a late recovery. But you can see there right at the bottom, Nvidia was actually the weakest of the seven, and that's surprising because Nvidia actually recorded very strong earnings in the middle of the month, really record-breaking earnings. But it couldn't help it from this sort of wobble in the AI rally that happened.
Yeah, that was surprising, particularly after such a positive news story. So it does really go to show that you can't anticipate or foresee what the markets are going to do.
Yeah.
So moving to another asset class, I'm moving to fixed income now. How did that perform over the month of November, and what's our current outlook for bonds?
Yeah, so just showing here the German 10-year bond yields throughout the year. We've had a lot of volatility in Eurozone bonds in particular due to these fiscal reform plans and advances in government spending that we have across the continent. But if you look there towards the end of this chart, bond yields across the Eurozone have crept up in the last couple of months. You can see here the 10-year German bond yield now at about 2.8%. And that's been due to a couple of factors. There's been a bit more of a hawkish sentiment around the ECB in terms of their monetary policy. There's also been more sort of worries around fiscal sustainability around those items that I mentioned, like greater government spending on things like infrastructure and defense. And it's partly also due to just a bit of a spillover effect from Japan, where we've seen a really particular weakening in their bond market. Yields in Japan now are near 20-year highs, and so that's sort of just fed into the Eurozone bond market as well.
And looking at commodities now as an asset class, can you talk to us about which commodities are currently experiencing significant price movements, and what are the driving factors behind these changes?
Yeah, so just starting, I guess, with the dollar again, just to note that this has been trading sideways for the last couple of months. Of course, we saw that rapid rise since the start of the year from near parity with the euro up to about 118, but it's traded sideways now in November as well. And that I guess has been due to the market sort of being more tentative in pricing in their opinion on the economy due to the lack of data around the government shutdown and due to, I guess, bifurcated opinions on rate expectations. But when we look at then commodities, starting with gold and oil, as we have done in past videos, gold, of course, has been on a stellar run for a number of years and has continued that this year. And again in November showed strong performance, and the price level of gold has really been supported by the structural forces that are driving this shift into the yellow metal, just being the central banks, particularly in emerging nations, are acquiring gold at a rapid rate. They're divesting away from currencies like the weakening dollar and into gold. And looking at oil then as well, the price of oil has been um, sinking so far this year, very volatile. But in November as well, we saw it drop further, and that was due to advances in peace talks between Ukraine and Russia, um, which would be anticipated to make the supply of oil more plentiful. But just what I'd like to bring in here is actually just the performance of silver, which has been on a really, really strong run in the past month or so. And that's been due to, first of all, higher demand due to silver being used actually in the manufacturing of many electrical products. But there's also been a bit of a constraint on supply of silver. And that's why we've seen just really strong performance in the last couple of months. Silver now up nearly 90% in euro terms for the year.
That's really interesting. It's particularly we mostly focus on gold and oil, but the connection between silver and the market developments is really interesting to keep an eye on. So what your slides have shown and what we've talked about here every month is that the investment landscape it's constantly evolving, and 2025 has mostly been in a state of flux and has been marked by uncertainty. So when you invest with Zurich, we have an expert team that are based in BlackRock in Dublin in the dealing room, who are actively managing funds in respect to the different market developments. Can you, Daniel, talk a bit about Zurich's current positioning and asset allocation? What active levers do we believe can be used in our multi-asset funds to manage risk and enhance returns in the current environment?
Yeah, I guess the best way to do this would just be to go through the different asset classes and kind of note our current positioning and our current outlook on them. In terms of equities, we are currently broadly neutral equities in terms of our allocation within our multi-asset funds, and so um, basically we think that the current risk return trade off within equities merits a neutral allocation. Within equities, then in terms of from a regional perspective, we do have a preference for Asia Pacific, which we've had for throughout the year over other regions. So trying to take advantage of the positive momentum in that region. And then also from a sectoral perspective, we do currently have a bias towards cyclical and growth sectors such as tech. Um, Moving on then to fixed income, we are currently modestly underweight government bonds, and we do also have a modest short duration position. So what that means is that our bond portfolio is a little less exposed to interest rate changes. And we do currently favor periphery issuers like Spain over more core issuers like Germany. Um, Looking then at corporate bonds, we do have a preference for credit over government bonds at the moment, but we are currently neutral in terms of our duration, so there's no major play on duration there to speak of. And in terms of alternatives, we have throughout the year and further on, we've held a very material active position in gold, an overweight position, and that does remain. As I said, there are still structural forces which are supporting the higher price levels in gold. And finally, in terms of currencies, we don't currently have a dollar hedge in place, but this is, of course, always under active consideration by the Zurich investment team.
Okay, great. I'll wrap up here. That brings us to the end of this month's update. Thanks, Daniel, for sharing Zurich's perspective on the investment markets. We hope that you found these insights valuable. So please feel free to share this video, and we look forward to having you with us again next month. So for more details on the Zurich fund range and to download our latest monthly investment news and our monthly Prisma report, visit zurich.ie. Thanks.